Hi guys! This is already the third episode for not-for-profit accounting. So, as a matter of recap, we have these topics and subtopics. So, we talked about already what is a not-for-profit organization. That is why, again, there is a check mark in here. So, it's on the episode 1 of this series. After this, we talked about fund accounting as used by the NPOs, and that is on episode 2. So, we already know that the NPOs use two funds: the net assets unrestricted, which was fully discussed again in the episode 2, and the other fund is the net assets restricted. That's what we are going to talk about in this video after this short intro. Here is the slide from the past episode. Here you can see the tubers, which are the components of the net assets unrestricted. But what about the net assets restricted? First, let's make all this disappear so that we can focus on the net assets restricted alone. So basically, the net assets restricted is composed mainly of temporarily restricted net assets and permanently restricted net assets. So temporarily restricted net assets are those funds that cannot be used freely by the NPO yet. But if the restriction expires, it will become unrestricted and free to use by the NPO. While permanently restricted net assets cannot be used by the NPO. But wait, what is the logic behind? Why do donors have to give something that can't be used by the not-for-profit organization? To make it clear, let's have an example. Mr. Baby donated 2 million worth of stocks to Bantay Baby Foundation, but he instructed that only the dividends can be used by the NPO. In here, we can already see the logic of the permanently restricted donation. We can see that even if the 2 million investment was not really donated for the usage of the NPO, the dividends can be used by the NPO for its programs and its activities. So even if it's not directly given, there is still a benefit for the not-for-profit organization. So let's have other examples, although they are not flashed in this presentation. So you just need to listen. Some donors give cash, but that cash, as per their instruction, should be kept in a time deposit, and only the interest can be withdrawn by the NPO to be used for its programs. So that's another example. So I have a last example. A donor donated his painting to a not-for-profit museum in the condition that it should not be sold and should forever be displayed in the museum. It makes sense, right? So that's all the examples that I could think of to let you understand the logic about donations that are permanently restricted. Again, even if the main donation is permanently restricted, there are still benefits that can be given to the NPO or that can be used by the NPO for its programs and activities. And I hope those examples did the job of clarifying. Now, before we end the discussion on permanently restricted net assets, I would like you to remember a certain fund, which is the endowment fund. When you see this, treat this fund as permanently restricted fund, okay? However, if it is stated that the endowment fund is board restricted, then it should fall on the unrestricted net assets under board designated funds. Because again, to be recognized here in the restricted net assets, there should be a direct restriction from the donor himself or herself. Again, if you see a fund named endowment fund, put it directly to permanently restricted net assets. So that's it for permanently restricted net assets. Let us now go to the temporarily restricted net assets. Actually, there are two types of temporary restrictions that can be placed by the donor. There are donations restricted by time constraint and donations restricted by purpose. But don't worry, we have examples. Let's start with donations with time constraint. Actually, I have already made an example of this many times before, but here we go again. We have Mr. Baby donated 2 million to Bantay Baby Foundation, but he instructed that the donation can't be used until 3 years later. So this 3 years here is the restriction. But after that time, the funds will be transferred to unrestricted net assets. So net assets with restriction will decrease, but unrestricted net assets will increase. And it will mean that such funds can now be used or spent by the NPO. We have net assets temporarily restricted by purpose. So we have our example here. Mr. Baby donated 2 million to Bantay Baby Foundation, but he instructed that the donation can only be used for scholarship purposes. So the NPO can only spend it for scholarship purposes, and that's the restriction. So if we are Bantay Baby Foundation, upon receipt of the 2 million, we have to debit it in cash, but credit it to restricted net assets. And if we use this fund for the purpose it was intended for, then first, we have to debit restricted net assets and then credit the unrestricted net assets to transfer the fund from with restriction to funds which can be freely used. And since it was already spent, then debit expenses, credit cash in case of revenue expenditures. But if it was used for capital expenditures like acquiring of assets or building assets, then debit assets and then credit cash. So that's it for temporarily restricted net assets. Before we end this topic, I would like to emphasize that NPOs can also receive funds, but they're just going to be the custodian of those funds. They cannot use the funds for their own programs, and even if the fund entrusted to the NPO earns some interest or dividends, such interests or dividends can still not be used by the NPO. If such is the case, then the NPO should debit cash and then credit liability. So what is a typical example of this? For example, an NPO received 5 million for example, but that 5 million will just be transferred from the said NPO to another NPO or other government agency. So if you are the NPO who receives such, that 5 million is not a donation and should not be part of either restricted or unrestricted net asset. That 5 million will be recognized as a liability of the NPO. To end this video, let's go again to the topics and subtopics. So we finished this one in the episode 1, and in episode 2 and episode 3, we talked about fund accounting, which ended with the knowledge that NPOs maintains two types of funds. The unrestricted net assets, which the NPO can use freely, and is composed of tubers. But if you don't know that, then go back to the second episode of this series. I promise you it's just very short. The second type of fund is the restricted net assets, which is composed of temporarily restricted funds, which are restricted either by time, constraint, or purpose, and the permanently restricted funds. So that's it for this video. So if you learned, please click like, subscribe, and share this video and the channel itself. You can also comment in the comment section below. And please don't skip ads. In the next episode, we will be accounting for donations, so stay tuned.